Amid all this uncertainty over the state of stimulus coming out of Washington, where do you see the greenback heading?
Good to be here, Nancy.
Good to have you.
We are quite bearish on the dollar, and not just from now into end of year, but on a multi-year horizon. And I think there are plenty of reasons to be bearish on the dollar. Interest rates have essentially converged with the rest of G10. There's hardly any demand for safe haven assets or safe haven currencies. And we have the elections coming up, which we think is also going to be a negative for the dollar. Now, in terms of what has happened, though, we had a fairly significant period of dollar weakness in July. The DXY corrected by over 4%. So it's not unusual that after you get such a strong period of one-way moves in the dollar, that you see some period of consolidation. And I think that's exactly what's happening in the month of August. It's probably reflective of short-term positioning of the markets. So we are a little bit more cautious over the next couple of weeks. I think the other factor to also consider is that so far, the dollar weakness has been very concentrated. It's primarily come against the euro and to some extent gold, but not against the other currencies. We see scope for this dollar weakness to broaden out. So outside of euro might remain in a 117, 119 range, but the dollar weakness might be expressed against emerging market currencies, against the commodity currencies. So that's what we are looking for in September onwards.
Okay, and Divya, what do you make, though, of the move we're seeing in U.S. Treasury yields to the extent that at times the dollar follows what's happening in yields? Because we are seeing a pretty sharp adjustment in that 10-year just from last Friday of more than about 50 bips, now over 70 bips on that 10-year.
That's actually very interesting, Nancy. So you're absolutely right. Nominal yields have climbed higher. But what's happening if you look at the breakdown between inflation expectations and real yields are still quite low. And inflation expectations, even though they have climbed higher, they are still at 10-year inflation expectations are still around 1.7%. 10-year real yields in the U.S. is still minus 1%. It's our expectation that nominal yields from current levels do not go much higher. Markets have the expectation that yield curve control will come in at some point. So that is going to keep nominal yields capped at around 70 to 80 basis points on the 10-year. What's interesting, however, is inflation expectations might continue to climb higher towards 2%. And if that happens, that's going to push real yields even lower. And we argue that if real yields go lower, that should be a negative for the dollar.